There was a noticeable change in markets today over the course of the trading day. When I finished up my daily live stream this morning, we were talking about how the Fed had stuck that soft landing, how the recession wasn't going to happen. There was even people talking about how Taylor Swift tickets and the box office results of the Barbie movie were somehow indicators of a healthy U.S. consumer. I kid you not, that's what they were talking about in the financial press today. But over the course of the day, things slowly started to change, and by the end of the day, people were saying, hey, maybe we really do have a debt problem, and maybe it really is about to blow up in our face. And as always, the culprit was central banks, not just the Federal Reserve, but also the European Central Bank and the Bank of Japan. Now, it all started yesterday with the Federal Reserve's rate hike where they raised by 25 basis points. No big surprise there. Everybody was expecting it. But the market glossed over the fact that Jerome Powell left the door open to another rate hike in September. That's something that the market wasn't really considering. And even this morning, the market had basically shrugged off any possibility of more rate hikes. And then this morning, along came the head of the European Central Bank, Christine Lagarde. Well, Christine Lagarde did the same thing that Jerome Powell did. She raised interest rates by 25 basis points. No big surprise there. But then Christine Lagarde surprised everybody by leaving the door open to a pause at the ECB September meeting. So she kind of did the opposite of what Jerome Powell did. Whereas Powell raised by 25 and then said, hey, we might raise again in September, Lagarde raised by 25 and said, we might take September off. And that's when things started to change. That was right around 8 a.m. Eastern time this morning. Now, when Lagarde did that, when she left the window open to a pause in September, while simultaneously Jerome Powell had left the window open to another hike in September, they both created the conditions where money started flowing from euros into dollars because you'll get more interest rate in dollars, especially if the two central banks are moving in opposite directions. And you can see that reflected in this chart right here. This is how many dollars it takes to make 1 euro. And starting right at 8 o'clock on the dot this morning, as soon as the ECB announced that rate hike but left the window open to a pause in September, we started to see the euro falling, the dollar strengthening against the euro. And you can also see that in this chart. This is the US dollar index, or the DXY. Sometimes people call it the Dixie. This is the strength of the US dollar measured against a basket of other currencies, and the euro is the single biggest input to this index. You can see right there, 8 o'clock this morning, the DXY started heading higher, and it continued higher for most of the day. Now, at the opening bell in the stock market this morning, there was peak euphoria. Everybody was talking about that 2.4% GDP read that we just got, which was, in my opinion, largely due to exploding levels of debt. But people saw that as a sign of economic strength. And you can see that right here above my head. When the NASDAQ opened up this morning, it was over 200 points higher, and it continued higher for about the first few minutes of the day. But you can see how that started to wear off across the day as the US dollar got stronger, as that DXY got stronger because the euro was weakening against the dollar. That euphoria in markets started to wear off a little bit. But that was right up until about 1 p.m. Eastern time this afternoon, when you can see the NASDAQ started to head lower, and it continued lower, virtually undisturbed, for pretty much the remainder of the day. Now, that might have you asking, what happened at 1 p.m. Eastern time today? Well, this guy happened. This is Kazuo Ueda, the head of the BOJ. That's the Japanese central bank. Now, Ueda took over as the head of the BOJ back in the spring, and he was widely considered to be a hawk, and it was believed that he was going to immediately start to shift Japanese monetary policy in a tighter direction. See, for years, Japan has been engaged in yield curve control, which is where the government prints basically infinite money, as much as needed, to keep bond yields suppressed. They basically print money out of thin air. They use that money to buy bonds. That bids up the Japanese government bond prices and suppresses their interest rates. Japan thinks that they can create a virtuous cycle of inflation by doing that. Now, Japan is something of an oddball. While the rest of the world has been struggling with inflation, Japan has been struggling to create inflation, and so they've been doing this crazy yield curve control policy for years. It hasn't worked. It's resulted in what's become known as lost decades for the Japanese economy. Well, Ueda was brought in to change that, or so we thought. Everybody thought he was going to change yield curve control right away on day one. That hasn't happened. He's been at the helm for a few months, and he hasn't made those changes yet. That was right up until 1 p.m. Eastern time today, which strangely is 2 a.m. Japanese time, when this article leaked in Nikkei. And this was no accident. This was the Bank of Japan deliberately leaking this story to Nikkei to try to move markets. The BOJ to discuss yield curve control tweak to allow rates over 0.5%. 0.5% is the level that the Bank of Japan has pegged as the maximum allowable interest rate for their government bonds. If bond yields ever went above that level, they would immediately print yen and buy the bonds to push the prices back up and push those interest rates back down. So this story is saying the Bank of Japan is going to start to very slowly let those interest rates rise above those 0.5% levels. And you can see the effect that that had right here at 1 p.m. Eastern Time, 2 a.m. Japanese time. The moment that Nikkei story hit about the BOJ allowing yields to rise above that 0.5% threshold, potentially, they were only going to discuss it. That was the story. Look at what happened to the value of the Japanese yen. Now, this is the number of yen that it takes to make $1 US. Before the story broke, it took 141 yen to make $1 US. A few minutes after the story broke, it took 138 yen to make $1 US. So this chart is showing us the Japanese yen strengthening against the dollar. The moment the Bank of Japan said we're considering letting those interest rates rise above just 0.5%, people started piling into the Japanese yen, sending its value versus the dollar much higher. Now, the really ironic thing about that story breaking in Nikkei in the middle of the night over in Japan and it having such a big effect on the yen is that it wasn't even really news. It's an old story. This article was in Bloomberg on July 21st, where they're saying the BOJ sees little need to act on yield curve control for now, but they said the board will likely discuss yield curve control change even as they hold. And that's exactly what this Nikkei story in the middle of the night in Japan said today. Again, they said they weren't going to change the 0.5% cap, just that they were going to let yields go above it. They're not going to enforce it as strictly, and that's kind of the same thing that they said on July 21st, but for whatever reason, they changed up the wording a little bit in the middle of the night, and they broke with this story, and all of a sudden it's having this big effect on the yen. You might be sitting there saying to yourself, what do I care? Jack, I'm in the United States. Why do I care what the European Central Bank is doing? Why do I care what the Bank of Japan is doing? And the answer is because of this. The United States 10-year Treasury yield. What happens in Europe and what happens in Japan and everywhere else in the world affects this chart, and this chart affects what you pay for a mortgage, for a credit card, for an auto loan, for any debt. The U.S. 10-year Treasury yield is the benchmark interest rate that all other interest rates in the economy are based on. And this is what the U.S. 10-year yield did today. It rose, and it rose big time. We started this morning about 3.86% on the U.S. 10-year Treasury yield, and then just after 8 o'clock, we started climbing with that news about the European Central Bank that they were maybe going to leave the door open to a pause in September. That continued until about 1 o'clock when the Japanese yen began to surge, and look, boom, big step change up again in the U.S. 10-year yield, and we ended the day over 4%. That is a very significant psychological reason markets sometimes throw a fit when interest rates go above 4%. And of course, that's what we saw in the NASDAQ and the S&P 500. Stocks did not like that rise in interest rates today. Again, we have an economy that is hopelessly dependent on debt. Almost all of that wonderful 2.4% growth in GDP that was reported this morning that had the Keynesians on CNBC just fawning over Jerome Powell and talking about the Barbie movie and the Taylor Swift tickets, it's all debt. It's government debt. It's consumer debt. It's borrowed money that is leading to this economic growth. Well, what happens to that economic growth when the cost of servicing all of that borrowed money, the interest on that debt, starts to go up? That's when we start worrying about bankruptcies, about defaults, about companies going under and laying off their employees, or that's when we start worrying about a credit event. And when there is a credit event, markets can go from euphoria to panic in the blink of an eye. And when you zoom out on this chart of the U.S. 10-year Treasury yield, you start to understand why. Remember 2022, what a terrible year in the stock market that was. Well, one of the main reasons why things were so bad in the stock market last year was because interest rates, because the 10-year Treasury yield was consistently grinding higher for pretty much the first 10 months of the year. And now the market has had this monster bull run where anybody so much as whispers the word AI and their stock goes up $100. Well, that has coincided with this decline in the 10-year Treasury yield, at least right up until these last couple of days. And what you're looking at here in this chart above my head is it looks like the 10-year Treasury yield may be done with this little consolidation or this bull flag pattern That's been going on since October. If we zoom in a little bit on this chart here, right above my head, you've got a golden cross in the 10-year Treasury yield. That's when the 50-day moving average moves above the 200-day moving average, and that is a majorly bullish or number go up indicator in the charts. And we just broke above this line here, which is this descending level of resistance. We're now above that line, coinciding with this golden cross, even as the European Central Bank pivots a little bit dovish while Jerome Powell is still hawkish. And we're worried about the Bank of Japan ending their yield curve control policy, which means the Japanese government, who is the #1 holder of U.S. government debt outside of the United States, may start dumping U.S. debt in order to get dollars to sell those dollars to prop up their Japanese currency. These are all things that put upward pressure on interest rates. And that is a very big problem for a United States government that's $32 trillion in debt, and for a U.S. consumer who has been putting the cost of inflation on his credit card for the last year or so. Now he's got that big balance on the credit card, and the interest rates he's paying on that are on the rise. So once again, we're sitting here and our economic well-being, our financial future is not determined based on our personal spending habits or even our performance at our day job. It's based on the whims and the opinions and the inflection in the tone of voice of guys like Jerome Powell or Christine Lagarde or Kazuo Ueda. The central bankers are determining the price of everything, and today the central bankers made a mess and the stock market hated it. Till next time, live small and dream big.